India Inc. gives a thumbs up to the Modi government's first year in office. 87% says the government has been pro-business in a CNBC TV 18 Forbes India CEO poll powered by BMR advisors. But all is not rosy. 60% are not impressed with the steps taken to herald a non-adversarial tax regime as promised.
Successful coal auctions take Piyush Goyal's power and coal ministry to the top spot of the best performing ministries. Jaitley's finance ministry at number 2, followed by the defence and railway ministries.
Reliance pumps in 7,000 crore rupees into Reliance Jio last fiscal as it gears up for a big bang 4G launch. Mukesh Ambani says the company is betting big on retail and e-tail in the annual report. Will also recommission all of its 1,400 fuel outlets by this fiscal.
5 of the world's largest banks face a $5.7 billion penalty in the United States. JP Morgan, Citi, Barclays, RBS and UPS plead guilty to rigging currency markets.
At 5,600 crore rupees, Tata Steel posts its biggest quarterly loss ever. Revenues fall a whopping 69% as growth markets like India and Europe remain sluggish.
The Finance Ministry notifies the high-level Committee on Direct Tax Matters. Justice A.P. Shah will be assisted by Dr. Girish Ahuja and Ashok Lahiri, who will initially examine the levy of VAT on foreign institutional investors prior to 1st of April 2015. Other direct tax issues will also be referred to the committee in due course.
Markets return to high spirits. The Nifty reconquers 8,400 as large caps lead the gains, but the mid-cap counters remain under fire.
It's the first time we have a global platform based in India and developed with Indian people.
Renault hopes to make a splash in the small car segment, launches its new hatchback Quid with a starting price of over 3 lakh rupees. Global CEO Carlos Ghosn says the company is set to raise its game in India.
Cement giant Ultratech looks to pick up the JP Group cement plant at Bhilai for up to 2,200 crore rupees. That's another CNBC TV 18 exclusive.
The SR Group makes a non-binding informal offer for Nokia's plant in Chennai. Deal to take on formal use only after the Delhi High Court gives its go-ahead.
E-tailer Amazon India strikes the second largest deal for office space, signs the lease for a new 1.2 million square foot campus in Bangalore to pay 28 crore rupees in rent for 4.5 lakh square feet in phase 1.
नरेंद्र दामोदर दास मोदी
The government has been doing a lot of firefighting on tax issues, but the question is that adequate?
Right.
So, it depends whether you see the half glass full or half glass empty.
Whether it is in power sector or in coal or in environment, I don't hear any complaint about stuff being held up.
There has been massive international engagement that has put India back on the world stage, including Indian business and India's investment attractiveness.
There are so many fronts where the government is actually working to ease the laws, simplify the laws, and bring in more transparency.
Well, it was a victory a generation of Indians had not seen. Narendra Modi took New Delhi and the nation by storm last year by becoming the first person in 30 years to lead a party to an absolute majority. A year has gone by, and has the government delivered? An exclusive poll conducted among CEOs is our top story tonight. Good evening. Thanks very much for joining us on India Business Hour. Hi, Nandara.
Hi, Shireen. And you have to say, after you look at that poll, it's all about tax, tax, tax. That's all India Inc. is still talking about.
And not in a good way. Let's jump straight into the findings of the CNBC TV 18 CEO poll. First, the methodology. The CNBC TV 18 poll was conducted in association with Forbes India and powered by BMR Advisors. 55 top CEOs, MDs and CFOs of some of India's top companies were polled in the month of April. And here are some of the key findings. An overwhelming 87% believe the government has been pro-business and pro-development so far. Another 78% believes that the steps taken by the government so far have led or will lead to better investment climate. Those are the big headlines that emerge from this survey. The poll also clearly reflects that the government still enjoys high approval ratings from corporate India. But, and there is a but, the two areas where there is clearly displeasure is the maiden budget and a continuation of tax uncertainty. 60% of the respondents believe that Arun Jaitley's maiden budget has not done enough to fulfill the promise of heralding a non-adversarial tax regime. So how can the government kickstart growth? Well, 65% of the respondents we polled believe that the GST will be the single biggest measure to put India on the high growth path. We'll get you more from the CNBC TV 18 CEO poll in just a bit. We've got a star panel lined up for you, but here's one big corporate voice backing Prime Minister Modi. Infosys founder N.R. Narayanamurthy says Modi is the right man to drive India back to the high growth path and he must be supported.
We have a new government. We have a Prime Minister who is very, very enthusiastic, energetic. He is working hard. We have a set of ministers who are in alignment with him. I think at this point in time, we should all rally behind him.
That's N.R. Narayanamurthy's views on the government's first year in office, and we'll be getting you the Star panel a little later on India Business Hour. But let's tell you what happened on the Lal Street today. The polls continue to march ahead. That's after yesterday's blip. The blue chips haunt the limelight today, with bank and IT stocks leading right from the front. The Nifty managed to reconquer 8400 mark. It did gain nearly 60 points in trade. Under the Sensex now, that was up by 200 points. It's within kissing distance of the 28,000 level. Mid-caps today underperformed that index, ending marginally in the red. And under the currency markets now, the recovery in the equity markets not reflecting on Main Street. The rupee lost ground against the greenback and closed 21 paise weaker. Strong dollar demand from banks and importers helped the American currency.
On to earnings season now, and it's not looking good for Tata Steel. Had a very tough fourth quarter. It's turned in a loss of over 5,600 crore rupees. That's against a profit of 1,036 crores a year ago. This is the company saw an exceptional loss of over 4,800 crores. Net revenues down 69%. Operating margins have tumbled to 4.6% from 11.8% a year ago. The company says that while volume growth is becoming evident, it has not been able to overcome the fall in steel prices globally.
Uptake in terms of volumes is already happening. So you can see that Q4 was better than Q3, and we will continue to move that way. In terms of margins, it will certainly be squeezed as it was, but we will see improvements on the cost side because we've already used up 3.5 million tons out of the 5 million tons of iron ore that we bought. As we continue to use the rest and use more of our own iron ore, we will see an impact on the cost, which is on the positive side. I think the rate of drop in NRs certainly is lower than, if you see Q1 of this year to Q4 of last year, it's less than Q4 of last year versus Q3 of the quarter before that. So the rate of drop has slowed down, and our cost should continue to come down as we use more and more of our own iron ore.
Well, a disappointing Q4 there for Tata Steel. CNBC TV 18's Nigel D'Souza joins us now to break down those numbers. Nigel, what's gone wrong for the company in this quarter?
Well, Tata Steel were expected to come out with a weak set of numbers, but they seem to have missed even those low expectations. So on the top line itself, they delivered a number of around 33,600 crores. We were estimating a number of roughly around 34,000 crores. So that's only a % miss on the top line. The total expenses, though, fell by only 14%, telling you that the operating margins were going to get compressed. And in fact, they came in at only around 5%. That's missed our estimates of around 9%. by a big margin. They were always expected to deliver a net loss on account of the big impairment, and that was really accounted for in the exceptional item. But we were really tracking the operational performance geographically. So let's run you through the Indian operations then. Deliveries were there more or less flattish, but realizations fell by more than 10%. And on the back of that, we were always expected to see some kind of pressure on the EBITDA per ton. But just looking at that, that's come in sub 7,000 rupees per ton, telling you that there was a cut of more than 50% on the Indian operations with regard to the EBITDA per ton. The bright spot, though, had to come in with regard to the European operations, because their volumes were expected to contract, and so they did. They came in down by close to around 6%, while the realizations took a hit of around 14%. But the bright spot has to be the EBITDA per ton, because if you calculate in dollar terms, they came in at more than $40 per ton. So that should be the only positive in these numbers, because if you look at the Southeast Asian operations, they were absolutely dismal. The deliveries were down by 6%. We did see that, in fact, the realizations were down by nearly 14%, telling you that the top line declined by 20%, and they delivered an EBITDA loss versus an EBITDA profit. So that clearly was a very, very sore point of their numbers. To sum things up, Europe was a bright spot, India and Southeast Asia a big disappointment.
Bad quarter for Tata Steel, the biggest ever loss reported by the company. Thanks a lot, Nigel. Shireen, it's not just sluggish demand, falling prices and squeezed margins that Tata Steel still has to worry about. Unite, the largest worker union in the UK, has decided to ballot its 6,000 members at Tata Steel UK for industrial action of the company's proposal to close the British Steel pension scheme. The company has proposed hiking the retirement age from 60 to 65 if the worker does not want any reduction in pension payouts. Should the worker retire at 60, he or she will lose 5% for each year of early retirement, which works out to a 25% reduction overall. The ballot calling for strike action and industrial action short of a strike will close on Friday, that's the 5th of June. Other steel sector unions like Community, GMB and UCAT have already opened their Tata Steel ballots, which will close on the 29th of May.
So trying times there for Tata Steel. But on to the other big story. Reliance Industries released its annual report today, and three things stand out. The telecom business has received a massive cash infusion of 7,000 crore rupees, and the company is betting big on retail and especially on online retail. And lastly, Reliance has decided to recommission all of its 1,400 fuel outlets by the end of this fiscal, and that makes sense because of the diesel deregulation, and perhaps we'll see other private players also getting back into this business. To talk more about the highlights from the report, we've got with us our Mumbai Bureau Chief Sajid Mangat. Sajid, besides the headline as far as the retail infrastructure fuel story is concerned, what else are you picking up from Reliance?
That's right. Reliance has released its annual report, and as part of the annual report, Reliance Chairman Mukesh Ambani has outlined that the company had invested nearly 100,000 crores or nearly $16 billion in FY15 on some of the business which will drive Reliance future growth. Now, these businesses include retail, Jio, and some of the gas assets overseas. Mr. Mukesh Ambani also put out a positive outlook on India's growth, saying that India is on its verge to get back its growth which it has lost in the last 5 years, and so there is a lot of optimism in the statement which has been made by Mukesh Ambani. On specific sectors where Reliance is putting its money in, Jio is one of them, where it very categorically states that 4G services across the country is gathering momentum. It's in strategic partnership with various partners for development and testing of those facilities. And what is important to note here is that Reliance invested or infused nearly 7,052 crores in equity in Reliance Jio in FY15. Now that takes the entire equity of Reliance Jio to close to nearly 30,000 crores. That's a huge equity base for a company which is about to start the telecom operation. On the issue of fuel outlets, Reliance has commissioned nearly 300 fuel outlets in FY15, and it says that it will be recommissioning the entire 1,400 fuel outlets by the end of FY16, and this is led primarily by the deregulation of the fuel sector by the government. In the retail space, Reliance has pointed out that its revenues from the retail has crossed 17,000 crores with an EBIT of over 400 crores. But what is more important is the kind of fact that it's entering e-commerce segment. It has already started a pilot project. It plans to take this pilot project to other sectors as well. If you look at the Reliance Reliance assets, which Reliance disclosed, it's over 3 lakh crores, and 1/3 of that is invested in new growth areas like the geo, the retail, and some of the gas assets overseas. So it's 1/3 of its fixed block now will be driving the growth for the next 5 or 10 years as and when they come on stream or go commercial.
All right, Sajid, appreciate you joining us. And of course, the standard disclaimer, Reliance Industries has management control of Network 18, which owns and operates the channel that you're watching, which is CNBC TV 18. Now, the Finance Ministry has notified the formation of a 3-member high-level committee on direct tax matters. This is as per what the Finance Minister had promised. The committee, which will be headed by Justice AP Shah, will initially examine all the MAT notices sent to FIIs prior to the 1st of April 2015 before other direct tax matters are referred to. Sapna joins us now with the details. And Sapna, the AP Shah panel finally being set up. Who are the other 2 members, and what exactly will the committee's role be?
Well, that's a pertinent point, because if you look at the composition of the body, it's very simple, headed by Justice AP Shah, and as CNBC TV 18 has also earlier reported, it will be a 3-member body, and 2 members will be independent. So you have Girish Ahuja. He's a chartered accountant and also assistant professor of commerce at the Sri Ram College. He's the other member, and of course, Dr. Ashok Lahiri needs no introduction. He was also the former chief economic advisor to the Finance Ministry, and he's also part of another committee which has been set up in terms of trade and industry on tax laws. There's another high-level committee, and he's already the chairman of that. In fact, this committee had already been set up in November last year, and just a couple of weeks back, I suppose, in terms of reference or other, some further update had come from that in terms from the Central Board of Direct Taxes. So it'll be interesting to watch so many committees all together and what all of them will do. But coming back to AP Shah, well, only the first term of reference is clear. That is basically handling the MAT issue in terms of the levy of MAT on FIIs prior to April 1, 2015, because from the current financial onwards, MAT is exempt for FIIs in terms of both equities and debt income. On this aspect, the one line that needs a bit of attention is that the panel will examine all the related legal provisions, judicial, quasi-judicial pronouncements, and such other relevant aspects as it may consider appropriate. So this is a very direct kind of a message that all those tax notices which has been sent in the past, there could be some way out on that front in terms of the FIIs at least. Coming back to the AP Shah panel, in terms of the other issues which will be referred, here the ministry is pretty quiet. It just says that, it will be notified in due course.
Yeah, well, this is all about FIIs and MAT, Sapna. Let's not kid ourselves. This is all the government's efforts to bring in some amount of damage control, because this was clearly an issue that has caught the government on the wrong foot. So, what else is going to be referred to the AP Shah panel doesn't really matter. And one would hope that these matters will be resolved expeditiously, though the circular does not, or the notification doesn't give out a timeline at this point in time. So I appreciate you joining us with those details. Now, the ghost of the 2008 LIBOR scandal continues to haunt banking giants in the US and UK. 5 banking giants, that's JP Morgan Chase, Barclays, Citi, Royal Bank of Scotland, and UBS, will together pay a fine of around $5.7 billion for indulging in the rigging of interest rates and foreign exchange rates. CNBC's Iman Javez joins us now to explain the implications of this. Iman, this was widely expected. The order has now come through. Take us through the reactions.
U.S. Attorney General Loretta Lynch today announcing a massive settlement by a number of global banks for foreign exchange rate manipulation by a group that called itself the Cartel. Now, Lynch saying that a number of banks here are facing serious penalties, including Citigroup, JP Morgan, Barclays, and RBS, all which will pay about $2.5 billion in criminal fines. UBS, meanwhile, is admitting that it broke the terms of its non-prosecution agreement in the previous LIBOR settlement. UBS will now pay a $203 million fine. The banks will also pay the U.S. Federal Reserve fines of $1.6 billion. And Barclays will pay a total of $2.4 billion to New York State, the CFTC, Great Britain's FCA, and the Department of Justice. All in, from all of these fines and penalties, Reuters is calculating the grand total here, $5.6 billion for all of these banks that have been involved in this. Now, a couple of key points, guys, to bear in mind. One is that no individuals are being charged here as part of this. Loretta Lynch saying in a press conference just after the charges were announced that the investigation is still open. The possibility is that individuals will be charged at some point, but no individuals charged here today. Also, no calculation here by the Department of Justice of what the total profitability was of this foreign exchange manipulation. So it's very difficult for us as outsiders now to look at these fines and penalties and decide whether or not this is a slap on the wrist or a very serious penalty, because we don't know what the banks ultimately made by manipulating foreign exchange rates. That number not being calculated here by the Department of Justice. But it looks like, according to Reuters now, the grand total here, $5.6 billion in fines and penalties from the global banks.
Eamon, appreciate you joining us. $5.7 billion fine, and Wall Street is reacting to that massive banking scandal. The 5 banks in the eye of the storm are all down by between 2 and 3%. In fact, the larger indices are also in the red. Let's just bring up the markets for you. That's JP Morgan. It's now down by about 0.5%. Barclays is it's up by about 3%, and Citi has lost about 1% or so. So those are the banks involved, and of course there's RBS and UBS as well. And RBS up by almost 2%, so not really reacting to the news out. I think it was a long expected lines and probably already priced in. The US market's also flat at this point in time. Well, and back home, we've got news from Renault.
That's right. India's going to become the 4th largest market after China, US and Japan for Renault. That's the promise from Renault's group chairman, Carlos Ghosn. To that end, the French car maker is bolstering its presence in the Indian markets with the launch of new products. The latest is its sub-4-meter compact hatchback, Quid, which was rolled onto Indian roads in Chennai today as part of the global premiere. Priced between 3 to 4 lakh rupees, the Quid will be produced at the Nissan Renault plant at Auragadam on an absolutely new Nissan Renault platform called the Complete Module Family A, or CMFA. And in a conversation with CNBC TV 18's Farah Bookwala Bora, Carlos Ghosn talks about how Renault is upping its game in the hyper-competitive Indian market. Here's a slice of that conversation.
This is a platform which has been developed in India using our best experience from France with Renault, best experience from Japan with Nissan, and also the creativity of our Indian engineers, because we have developed a technical center. So this is a big difference. This is the first time we have a global platform based in India and developed with Indian people, number one. Second, this is the first car on this platform, and this car is 97% localized from the beginning. So we are putting all the elements from our side to make sure that since the concept of the car, everything is geared toward success in India, which has not been the case for other products that we are selling today.
What kind of, are you looking at an export strategy as far as the Quid goes?
The capacity of the Quid will be particularly dedicated for the Indian market. This being said, there will be some export for the surrounding markets of India. There may be also some very limited export to other regions to test the car in other regions. But I don't think you're going to have a massive export for a very simple reason. I think the success of this car is to be localized. So for example, if you want to develop this car in another large market and you test it with some exports from India, and if these exports are successful, you're going to need to develop a plant in the market itself in order to keep the competitiveness of the product.
It's been a trial by fire for Coal and Power Minister Piyush Goyal in the past year. Goyal has successfully conducted India's first auction of coal blocks, averting a crisis. He's also pushed Coal India to ramp up production to a historic high and better the target of power generation. While the start has been strong, Goyal will have to walk the mile to achieve the government's target of 24/7 power for every home by 2019. Here's the report card of Piyush Goyal, who's emerged and whose ministry has emerged as the #1 performing ministry in the CNBC TV 18 CEO poll.
Coal and Power Minister Piyush Goyal and his team have spent the past 12 months burning the midnight oil. With the Supreme Court order cancelling the coal block allocations going back almost 2 decades, Goyal was tasked with ensuring continuity of production to avert a coal and power crisis. The government pushed ahead with coal reforms via an ordinance, paving the way for the country's first coal block auction. In the first phase, 29 coal mines have been auctioned and 38 allotted to government companies, giving the government an opportunity to crow about the benefits to coal-bearing states. Proceeds from the auction at over 4 lakh crore rupees have eclipsed the CAG's controversial 1.86 lakh crore loss estimate. The auctions have also had a fair share of drama, forcing bidders like JSPL to move court against the government's decision to reject its bids. Auctions apart, Goyal has also pushed Big Boy Coal India to ramp up production to 32 million tonnes, that is 8% higher than FY15 and the highest ever for the company. Coal India is now targeting 1 billion tonnes of coal production by FY20. In his role as Power Minister, Goyal has overseen generation of an additional 22,566 megawatts against a target of 17,830 megawatts. Energy deficit has come down to an all-time low of 3.6%. While on the transmission side, the Power Minister has promised competitive bidding for projects worth 1 lakh crore rupees in the next 6 months.
While things have improved for both coal supply and generation, the distribution companies owned by some of the states are still reeling under financial stress despite being put on a restructuring plan. The logjam on setting up new ultra-mega power projects continues, with the recent setback being Reliance Power walking out of the proposed Tilaiya project. The government is yet to release a redefined bid document on ultra-mega power projects.
Goyal has also helped alleviate some of the pain facing gas supply by bringing in reverse bidding for gas to kickstart stranded power plants. A good start, but Goyal has his work cut out for him as he fulfills his promise of lighting up every home 24/7 by 2019. In New Delhi with Anshu Sharma, this is Shireen Bhan.
The best performing ministry, according to our poll, from one ministry to another, the Commerce Ministry headed by Nirmala Sitharaman has had to battle a weak global environment which has hit the growth of India's exports. She's also had to woo foreign investors to buy the India story again and get the ball rolling on the government's Make in India mission. Exports are down, FDI inflows are higher year to date, and liberalization of the FDI caps in sectors like insurance and defense could see things improve even further. Here's the Commerce Ministry's first year report card.
Indian exports have not seen any achhe din under the Modi government in the past 1 year. When BJP's firebrand spokesperson Nirmala Sitharaman took over as the Commerce and Industry Minister in May 2014, she inherited a double-digit export growth, but a year later India's exports were deep in red. India recorded an export growth of 12.4% in May 2014, but within 4 months, export growth slipped to single digits and in April 2015 hit rock bottom, declining 21% to $24 billion. A massive 35% decline in exports to EU combined with weak export demand from Asian markets pulled down India's exports. But what made matters worse was an outdated foreign trade policy which was being administered under extension by Udyog Bhavan. Sitharaman announced a new foreign trade policy on the 1st of April this year. 2 new schemes were launched by amalgamating old policies through which government will refund 2 to 3% of the value of a consignment to exporters. A similar scheme for service exporters, that is hotels, IT, hospitals, accountants, serving foreign clients, was also launched. In the past year, the Commerce Ministry has engaged with trade bureaucrats from the US, Japan and China in an effort to bridge differences over issues like IPR, trade deficit, market access and easier investments. These dialogues led to the formation of interministerial panels to facilitate trade and investment from US, China and Japan. While on the trade front the Modi government is yet to show conclusive results, one saw big bang policy interventions on the investment side. FDI and railway infra was fully opened, FDI and construction development was eased with relaxed norms for minimum area and lock-in period, FDI and medical devices was opened, and FDI and defence was hiked to 49%. The defence sector also saw validity of industrial licences being hiked to 10 years and DIPP cleared licence applications which were stuck for over 5 years. The biggest initiative to boost investment came through the DIPP's Make in India campaign, through which 25 focus sectors will see interventions related to the ease of doing business and the creation of new infrastructure. Since the launch of Make in India in September, FDI equity inflows into the manufacturing sector rose by an annual 45%. In fact, in FY15, FDI equity inflows grew at an annual 26.15% at 31.8 billion, as against a 10% rise a year ago at $25.27 billion.
The Commerce Ministry will have to work on ensuring a better ranking for India in the Ease of Doing Business Index, which will be released this autumn by the World Bank. But for that to happen, it will have to convince states to adopt best practices like a robust single window clearance system as well as time-bound clearances for projects at the ground level. In New Delhi, Rituparna Bhuya.
Well, that's a report card of the Commerce Ministry. And of course, we will continue to assess the performance of the Modi government through this week here on CNBC TV 18. The markets closed higher. We'll pick up on that and more when we return. Till then, from all of us here, goodbye. Many thanks for watching.